Yeah, welcome. Today, this is our audit debrief, and this is really designed to provide some audit insights for you as HVRP grant recipients. So we'll be presenting a recap of a presentation that we actually did in June. So today will be a refresher for those returning, but also wanted to make sure that we were giving some highlights to those that are new grantees. So looking forward to presentation today. So next slide, please. Okay, so my name is Wendy Allen, and I'm a managing director with KPMG. Today I'm joined by Alan Devine, who is also a managing director, and then Lucy Rutter and Jennifer Mead are senior managers. And we are all part of the federal audit practice here in DC and have been fortunate to work with VETS for a number of years on these audits. So by way of background, VETS has engaged KPMG to conduct performance audits over JVSG and HVRP grants. And our objective is to determine compliance with terms and conditions and uniform guidance as it relates to financial management. So we perform the audits in accordance with government auditing standards and consulting standards and issue an audit report we call it a performance audit report, but we are focused on financial information only. So specific focus areas of the audits include personnel and benefit costs, other direct costs, which for HVRP would include things such as participant support costs, indirect cost, cash drawdowns, and then reporting to VETS. And we are not issuing an opinion, but we do document our findings and provide recommendations. So VETS is really, the end game here with VETS is that they've engaged us to perform these audits, looking for opportunities for improvements, and then also an opportunity to learn, capture some lessons learned and make updates to guidance or trainings. Our agenda today will be a summary of audit findings that we have noted, and then also lead practices. Based on these audits performed, we've identified various common findings, and we'll share them today, along with some noted themes that you should all be aware of. And then we'll also cover some specific examples and then speak to what we recommended in our reports to address those findings. We'll then also share some leading practices at the end that can assist you with your sound financial management, which is the name of the game, and then provide some information about trainings that VETS has available, and then share some additional information about how best to prepare for audits should you be selected. So Module 1, as noted, VETS utilizes our findings to identify where guidance may be lacking or clarification is needed. Your GOTAR is the key resource for you, though, but it is your responsibility as the grant recipient to stay informed about relevant guidance and any updates to the requirements. But this presentation, along with others conducted by VETS, is designed to highlight those kind of potential challenges you might encounter as it relates to financial management and better prepare you for them. So on the next slide, key themes of common findings. So the criteria is what we use. We call it criteria. That's what we use to determine whether compliance is met. And that was as discussed earlier. This comes from different sources, such as the terms and conditions of the grant, uniform guidance. And it's as noted previously, it's your responsibility as the grantee to ensure you're in compliance with this criteria. We've conducted over 50 audits, and these are 3 common repeat findings that we've noted. Issues are with readily available supporting documentation, allocations, and then specific reporting related financial practices, which is identified through our financial reporting test work. And so we'll cover these items and in the following slides and give you some kind of specifics on what we're seeing. So thank you. The next slide, the first common finding is related to availability and maintenance of supporting documentation. So part of the criteria that we're using is the uniform guidance related to supporting documentation, and that the concept that entities should keep adequate supporting documentation to be able to evidence that the funds were used according to the terms and conditions. And we also, you'll hear the term readily available. We also cite that in our criteria. That's really that all documentation should be readily available for examination and that it is properly managed and maintained. So when the auditor or your GOTAR, you're asked to support a cost that you are requesting reimbursement for, that it is readily available. When performing, and just to kind of go through some specifics, when performing test work and review of payroll and benefit costs, we often identify the inability for recipients to provide documentation such as timesheets, pay rates, and perhaps job descriptions due to the nature of their systems or changes in positions. So we notice that maybe in larger entities, the HR department may be separate and additional data calls may be needed. And so we often try to select our payroll and benefit samples first to ensure they've got enough time to provide that auditee has enough time to provide the support. But we've also seen in the smaller entities that timesheets may not even be used, or there's not a process in place to document pay rates or increases. So it really comes down to having that documentation to support the costs that you are putting through. We've also identified situations in which documentation provided is reliant on system reports, notably as it relates to calculating allocations. I know Jen is going to go through some of those examples too, but documentation to support the underlying costs in the allocations was not maintained and readily available. And we see this again with larger entities as well. There is maybe an inadvertent reliance on system reports and not necessarily the ability to provide an explanation or support that, to validate and test the calculation allocation. Like we will be asking for a kind of an audit trail of that and to fully understand how these calculations are being made. The expectation is that you understand what your system is doing. So again, it's important to have an understanding of what's going on in your system and the ability to pull out that necessary documentation so that we can re-perform any calculations. And we've also identified some situations in which documentation for costs that were moved between reporting periods were not maintained to show why it was appropriate to move costs, perhaps between different program years, as an example. And really, I think the name of the game is any adjustment that may impact reporting or timing of when you're reporting something, any adjustments related to that, like journal entries, should really have good support and have a good audit trail. Common recommendations in this regard for supporting documentation include, obviously, supporting documentation should be readily available. You should also consider the relevance and reliability of the source documents that you're maintaining. You should also ensure that the supporting documentation that you're providing agrees to the transaction amounts. So there is a clear delineation between what is in your records to what is actually the source document. And then there's also retention requirements that you have to keep in mind, which is at least 3 years after the submission of the final quarterly report. And then again, that consideration of payroll and benefit documentation and whether that is readily available. As grant recipients, it's important you have quality documentation to support all costs charged to the grant, but the information is readily available and that can be provided timely is key. And so now I'm going to hand over to Jen to take us through some more common findings, specific allocations.
Thanks, Wendy. So the next common finding that we've identified is related to allocations, and we have 4 examples to talk through here, which were all identified as a part of direct cost test work that we performed. So we selected a sample of expenditures incurred and requested supporting documentation, and these costs were ultimately allocated. So these relate overall to the direct cost allocation principles that require that when a cost benefits 2 or more projects or activities, that if it can be determined without undue effort or cost, then the cost must be allocated to the projects based on the proportional benefit. And the methodology used for the allocation will be based on the nature of the underlying cost, but it should result in a proportional distribution of costs and generate reliable and predictable results and be consistent. So with that background, these 4 examples to talk through. With the first one, in this case, the grantee could not support the allocation methodology utilized as documentation of the methodology was not retained. So we selected a sample of rent expense that was allocated, but the documentation to show what rate was used and how that rate was determined was not available. In the second example, the grantee did not maintain documentation of the appropriateness of the allocation methodology. So they had selected the methodology to use based on the cost, but we had some questions about the appropriateness of that methodology, and they were unable to provide documentation to support it. And a reminder here is to also revisit the methodology to make sure that it remains appropriate. So if you're using full-time employees or square footage, if something major changed with location or individuals, that's being updated and considered as changes are made. The third example was an inaccurate application of the methodology. So in this case, what was actually calculated was incorrect. So what ended up getting reported, we recalculated a difference from that. So we did get support for the rate, and in this example, the full-time employee report, but when we reperformed, it was inaccurate. And finally, in the fourth example, the grantee did not allocate a cost that should have been allocated, a rental cost, because it did have proportional benefit. So in this case, it was slightly overcharged because there should have been an allocation. And overall, with these findings, our recommendations related a lot to enhancing the review of the allocation calculation. So to make sure the amounts calculated are accurate, the methodology is supported, and it's also appropriate. Another recommendation is to ensure that the methodology is allocating by the proportional benefit, so considering the type of costs and allocation based on the nature of the cost. And finally, to ensure that documentation for allocation is maintained, including if it's a system allocation calculation, that documentation is maintained and understood so it can be reproduced and followed. Then on the next slide, we have a few subtopics related to financial practices. So we have identified various findings in these areas when doing our procedures over quarterly reporting. So they don't directly relate to quarterly reports being inaccurate, but they relate to recording transactions incorrectly, which then impacted quarterly reports. So moving into the first topic, indirect costs, on the next slide, we have 5 examples to highlight here. For the first example, the indirect costs that was recorded in the transaction detail, which is something that we request as part of the audits, didn't agree to what was reported on the quarterly reports, which is required in the final FFR, but also in this case, the grantee reported on the FFR on earlier quarters as well. The second example was related to, in this case, a grantee that was using the de minimis election for indirect costs. What they had reported to vets as the indirect costs for the period exceeded the amount allowable under their election. The third example was that management was unable to support the base used. So we requested support for the base times the rate. We did have support for the rate, but they could not provide the detail used, whether it was payroll and benefits, to support the actual indirect cost that was incurred and reported. In the fourth example, there was a change in the indirect cost rate that wasn't timely implemented. So the grantee did perform a calculation of the adjustment based on the change in the rate, but did not include that in the quarterly reporting. And finally, in this case, kind of a little bit different situation than the first four, but resulting in an undercharge of indirect costs. The grantee did not calculate and report indirect costs for reimbursement for all of the eligible transactions that they could have in the base. And with these situations, we had overlapping recommendations. And one of the key recommendations is to enhance reporting controls over the review of quarterly reports to vets, including the FFR, and focusing this review to also include the indirect cost section. So it varies how indirect costs are determined by each grantee based on your election and situations, but considering, however, your indirect cost methodology is just to make sure that what is being reported is accurate. So if you are using a NICRA, to make sure that you're using the approved rate times the base, that calculation is accurate, and just having this as a key element of review of reports. Second, which is kind of a theme overall with the various types of finding, is to maintain documentation of the base and the rate used to determine the indirect cost. Especially if the calculation is not done directly in the financial system, and if there are any adjustments that are being made when determining what the amount is, just to maintain that specific file Excel that you're using for the calculation. And then finally, if the indirect costs are based on system allocations, to make sure supporting documentation is available to support the underlying cost and what rate is used. The next slide, we had a finding related to first in, first out. So this was based on a review of quarterly reports where management did not use grant funding on a first in, first out basis. So certain expenses were charged to the program year 23 grant before the grantee used all of the funding and expended all the funding on the program year 22 grant. And we also highlighted in the second bullet the criteria that is from the terms and conditions that requires that recipients expend funds with the shortest period of availability first. So kind of what good looks like in this situation is to ensure that funds are reported as expended before beginning to utilize the next program year, and especially keeping focus on reports that cross period. So if you're filling out two reports at the same time because it's within the period of performance or overlapping, just have that as part of the review control to make sure that if there are prior year program funds still reported as available on the FFR, then those are used before reporting and using current year program year funds on the subsequent FFR. And the next slide. So this finding related to reporting is prior year expenses charged to the current year grant. So we have a timeline here kind of showing the situation, and in this case it was a partial prior year expense. So the invoice for phone charges had a billing period of June 15th to July 15th. The beginning of the period of performance was July 1st, so it crossed over that period, and the invoice was received toward the end of July and then paid early August, and all funding for the program year 23 grant was used. So in this case, that first portion, the first half of the invoice was from prior to the period of performance. So the program year 23 funding should not have been used for the pieces that occurred prior to it. So recommendations in this case is to ensure that review controls focus on review of the timing of the invoice. So to make sure that the appropriate funding is used, especially when you're toward the beginning of the period of performance, to keep that in mind. Another one is vendor management. So to keep track, make sure that you're timely invoiced, and if you're aware of invoices coming in, to track that, to make sure vendors are sending invoices timely, and then reaching out as needed. And then finally, to consider and make sure that the accrual basis of accounting is being utilized, which we will talk about in more detail now, and I will pass it to Alan to do so.
All right, thank you. Not sure why my camera's not showing up, but we'll continue as is. So let's talk a little bit about the accrual accounting. And what we found here is that although it was being reported that management, the grantee, was using accrual accounting, we were finding costs that were not recorded at the time that they happened. And as a result, those expenditures on the quarterly report were understating costs as incurred until the following report, when those costs actually ended up showing up on the reports. And so if we want to go one more slide. Great. We wanted to share with you some examples of how to make this decision. So if you're looking at your transactions, you're trying to decide, okay, when is this a cash basis and when is it an accrual basis? Remembering that the accrual basis is now the standard we have to report by, we've got this chart to help you out. First, in a situation where you're ordering supplies and laptops, under cash basis, when you pay that invoice is when you record that as the outlay. That's when you put it on your quarterly reporting. Under the accrual basis, you record that when you receive the supplies. And so the invoice might not show up for another week or two. You might get that invoice and then pay it a week or two after that. Both of those events do not result in the recording of the expense. It's when you've received the supplies that counts the most under the accrual basis. Second, what about participant support costs? All right, so again, the cash basis you see there, when you actually make the payment, that's what we mean by cash basis, and that's no longer how we report these costs on our forms. What we're looking for is when the participant support cost is incurred. So when you provided that support to the participant, that is when you're going to be incurring the cost. Not when you necessarily pay for the clothing or whatever it might have been that this participant received. It's when you've incurred that cost for that support. What about training classes? Again, let's avoid recording it when the invoice for that training session is being paid. That is what triggers a cash basis recording. What we want to see is you record that accrual expense outlay when it becomes too late to cancel for a refund, right? So you sign up for a training and the training program says you have 1 week to change your mind. Maybe it's 2 weeks to change your mind. Maybe it's 1 week before the session starts, before the training session starts, and you wait, and all of a sudden that date comes. That's when it's time to record that training, when it's too late to cancel the refund. Now let's look at salaries, wages, benefits. Again, under the cash basis, that's when you're recording it when it's paid, when that paycheck is cut and given to the employees. That's the cash basis. That's when they are getting the actual cash, right? But what we're looking for under the accrual basis is when the time has been performed. And so when might this show up? Well, sometimes your pay period will end on one Friday, but the paycheck for that pay period won't go out until the following Friday, right? So you have 1 week after the end of the pay period that check gets issued. So we want to make sure that you're recording those costs on an accrual basis, and that means recording it at the end of the pay period, all right? Not when the paycheck is cut. Now, the last thing we have is MIS upgrades, right? So in this case, again, maybe you're doing a big upgrade, you're getting some equipment, some things are coming in. And so what do we look for here? Not when you paid the vendor, but when the order cannot be canceled for a refund, right? So just because they brought in a bunch of servers or what have you, and they're sitting there, it's not until you can no longer get a refund for those items that you record the accrual. And certainly if you're making payments well after that, that's what we want to avoid. So we've got these examples here. Hopefully that will help you out in understanding and avoiding recording things as cash basis, because now we are required to be recording these expenses under accrual. Lucy, can we go to the next slide, please? All right. Now, we've been conducting these audits for a number of years, and as we do these audits, we do tend to see repeat findings, things that come up, but every once in a while, we do have some new audits, some new audit findings that come up. And so we wanted to share some of those with you. These are the things that are more recent for us, and so hopefully we can nip them and make sure we don't have that happening going forward. So what did we find? Here's a summary of those items. In the next couple of slides, we'll talk about them individually. First is the frequency, timing, and amount of drawdowns. So the first thing we saw was the drawdown amounts reported on the cash receipts and cash disbursements line of the FFR did not agree to the actual drawdown amounts per the PMS system. So what did that mean, right? Well, the grantee here was recording what they thought they drew down and not what was actually recorded in the drawdown. So what does good look like? What should you be doing? Report the drawdown so that it reflects the amount actually drawn down. And if you need to go to PMS, make sure you're doing that so you have the right information. The second condition we saw that was a finding where grant funds were being drawn down using a predetermined amount on a monthly basis rather than actual expenditures incurred for that specific time, right? So in this case, the grantee was thinking, all right, we spend about $100,000 a month, so that's what we're going to draw down. That's not the way you should be doing it. You need to be drawing down what you're actually incurring. So what did we recommend there? What does good look like? Design and implement controls to monitor and review the grant drawdowns so that they're aligning with your actual expenditures incurred. All right, Lucy, next slide. All right. So what are some other things we saw here as it relates to unsupported fixed allocation of payroll taxes and benefits? So we had three things we saw here. In the first case, the grantee was unable to provide documentation to support the rates being used to determine the benefit costs charged to the grant. And so we were not able to substantiate the rate that was used to charge the benefit cost to the grant. And so what you want to be doing, what does good look like here? Make sure you have policies and procedures to require documentation to support those rates that are used to calculate whatever the benefit charge is to the grant. And that's going to help us when we come out as auditors. We could just ask for that documentation. What is it? Is it a straightforward calculation? Is it a ratio? Whatever it might be, if it's documented, then we as auditors can look at that documentation, reperform it, get the same number that you all got when you charge that expense to the grant, and everything works out for the audit. The second condition we had was that payroll taxes charged to the grant were recorded as a fixed percentage of salaries instead of the actual payroll taxes incurred, and support to evidence why that was being done was not available. So typically we would expect that the payroll taxes charged against the grant would be those that were paid, those that were incurred. But this grantee was using a fixed percentage. Now, is that okay? Is that not okay? We couldn't tell because there was no evidence to tell us why that was all right. So if you find yourself in a situation where you're charging an amount that's not directly tying back to what's being paid out, you're going to need to prove that to the auditor through some kind of documentation. So what did we ask the grantee to do better? What would good look like? Develop those policies and procedures to require supporting documentation to be maintained to support those benefit costs charged to the grant, all right? And if you do that, and then when we start asking the questions, you're going to have that document ready to go. You can just hand it to them and boom, everybody's good. Now, what was the last condition we had here as it related to payroll taxes? Benefit costs were calculated based on an approved monthly fringe rate. That's what they were doing. They had an approved rate, but it wasn't updated timely when the new rate was approved. So what happened here? The grantee had a process to calculate a new benefit cost rate, and the month that the rate changed, they used the old rate. They forgot to change it in the system and use the new rate that they had approved. Simple mistake, we understand that. So how can we fix that? How can we get to what good looks like? Make sure you have policies and procedures to verify the appropriate rate is being utilized. If you know you're changing the rate on a monthly basis, on a quarterly basis, on a semi-annual basis, think about having policies and procedures that are going to say every quarter, double check that the rate is correct, that we've changed it to the new rate. And that can help prevent you accidentally charging the wrong rate to the grant. All right, let's go one more. Lucy, I'm not seeing that pop up. Are we on 17 yet? Ah, there we go. It just showed up for me. Thank you, Lucy. All right, what is our next audit findings? Well, it related to gift cards and evidence of receipt of those gift cards by the participant or by the individual getting the benefit. So what were some of the things that we were having issues with? One, evidence of distribution for the gift cards, allowability for the gift cards, and then issues with bulk purchases of gift cards. And so what does good look like? Well, there's actually a VPL out there to help you with this. It's VPL 0624. And what's in there? What are you supposed to be doing? First, you've got to have standard operating procedures. Grant recipients must maintain written procedures to ensure participant support costs and participant incentive costs are implemented and executed consistently. Second, supporting financial records, invoices, and receipts for incentives and participant costs incurred must be supported in the grant recipient's budget narrative, right? So what are those things you should see in your policy to make sure you're avoiding these issues of lack of evidence and missing things? Amounts and types that are being used. Criteria for issuance. Who gets these gift cards, right? What is the rules for that? Who authorizes that? Who's the one who says this is okay to do? Evidence that the participant has received the gift card, right? Do they sign for it? Do they sign a paper that says I received the $50 gift card or what have you? Who's holding all the gift cards, right? So who in your organization has access to those 30 gift cards that are handed out once a month or what have you? Recording and reporting. So is there an inventory of those gift cards? Are you making sure recording those costs? Are you reconciling that, right? So if you say you have 30 gift cards and your inventory says you have 28 left, do you have 28 left? Have you done that count? Have you made sure that you haven't had any gift cards go missing? And what are the things that can do to help make sure those things don't happen? Segregation of duties. Who has access? Keep that separate from the people that approve the use of the gift cards. The authorizations. All right, one more slide. Right. So the last slide we have here is just some suggested trainings. So Smart 4.0 webinar training series has some great trainings, different modules that are listed for you as a grantee to get a better understanding of the different rules that you're going to have to follow by being a grantee. So we've highlighted the specific modules. There are a number of other modules available for you. And the second link we have there is to policies and procedures training that are available as well. So I'll move it over to Lucy to take us through the last couple slides.
Okay, thank you. So we're heading into our last module, which is module 2, and we'll just quickly go through some leading practices as grantees. So first item is cross-training of individuals. When we've been completing the audits, we've noticed sometimes at grantees, individuals may have left the grantee or retired, and then during the audit, we have questions over something they did and the grantee isn't able to provide an answer. So just making sure you're cross-training your individuals so that everyone that supports the grant has the appropriate knowledge of the processes affecting the grant. Also looking at the proficiencies of those responsible for financial management related tasks and just making sure there's the appropriate training for there. Next is for information systems. So as we've kind of went through a few findings earlier that involve information systems, but just making sure you have understanding of your financial system capabilities, understanding how the other systems flow into the financial system, such as payroll, if that's in a separate system that then flows in. Being able to run reports to provide the appropriate level of transaction detail that we'll need in the audit. Having the ability to trace transactions from the originating document, especially if it's selected as an audit sample. And then, like we went through earlier, just understanding your system's abilities when it does certain calculations. So if it calculates the indirect cost rate or the indirect cost amount or other allocations, just understanding how the system is making that calculation and being able to reperform that. Next item is just making sure you're maintaining support for any adjustments, such as cost moves if you're moving costs in between grant years. Through the recommendations we've mentioned for the earlier findings, just making sure you have effective internal controls, so appropriate approvals, having segregation of duties in place, having the knowledge and understanding of the hierarchy of the guidance that is applicable to the HVRP grant, just timely reporting and timely making your drawdowns, asking any questions to clarify guidance from Vets National or your GOTR, and then just making sure you're maintaining clear policies and procedures and that those are all documented. I did just want to highlight, as we have reached the end, but we have included 2 appendices within our slide deck. So first one is just audit preparation. So if you are selected for an audit, this just has a few bullet points of ways you can prepare. And then there's a second one, or a second slide related to documentation requests. So this just helps list out some of the documentation we might request during the audit, and also how we mentioned in the findings of having supporting documentation available, having clear policies and procedures. So that is included in the slide deck as an appendix and can be used as a reference if you are selected for an audit. Just to go back here, I know we're probably close to our time limit. So if there are any questions for us, I think probably feel free to send them to Vets National, and they can pass on any questions if needed to us.